what do you care about more, sort of future profit or solvency or central banks? And I say that because JP Morgan had a note out basically saying that the suppression of the risk-free rate and credit spreads by the Fed likely is going to have a bigger impact on equity valuation despite the temporary earnings loss. Is that something that you subscribe to?
Well, I would look at it differently. We look at a distribution of outcomes in any investment process. The extraordinary measures of the Federal Reserve and by Congress have cut off the left tail, if you want to use that nomenclature. They have lowered the likelihood of call it a second depression or a going into the abyss. And the Federal Reserve has done a number of very important steps in terms of backstopping the commercial paper program, in terms of supporting the IG market, investment-grade bond market, into the municipal market. They've done a lot of things in Congress, of course, with the revenue replacement, on the extended unemployment benefits. All those things are critically important in reducing the left tail outcome. That's important. But it doesn't address necessarily the right tail, and I'm not suggesting that that's a requirement or an obligation of the policymakers. I'm just saying, as an investor, looking at the potential outcomes, it lowers the downside, but it doesn't necessarily speak to the upside. The upside, or the forward path, is really a function of corporates restarting their business, the bending of the viral curve and how that's spreading medically, and also individual humans in terms of their willingness and the behavioral changes. And so when you look at the upside is relatively more limited from my perspective. You look perhaps 10% upside in the S&P 500 towards a 3,000 level at the end of the year. But tactically, it probably goes lower on the near term, and it's on the back of uncertainty and what happens in the path going forward. That's pretty unclear, and so it suggests that valuations are still likely to go lower, although by the end of the year, probably the market will be higher.
So I'm curious then to see how you look at companies' capital allocation in terms of CapEx, because the companies that do survive are going to have to rejigger their businesses in terms of how they're going to deal with the virus going forward. Buybacks now feels like they're non-existent. You mentioned earlier dividends getting cut. Where do companies allocate, and what do investors want them to do?
Well, it's an excellent question. You know, the first and most important thing is for companies to remain in business, remain solvent. So the reason for companies to cut discretionary investment ideas, so they'll maintain their maintenance CapEx, they'll cover depreciation, and they'll cover much of their research and development. We anticipate that to be taking place, but the discretionary decisions on buybacks and some of the dividends are more suspect. It really depends on the business model of some of the companies, not the business model, but the businesses in which they engage. Some are much more stable, and those companies have reiterated or, in fact, increased their dividends. Look at Johnson & Johnson, Procter & Gamble, last week announcing 6% dividend increases. Each of those companies raising their dividends. So some companies are in the position to do that, and investors are appropriately embracing that, and we would be advocates for companies or advocating, companies that are in a position to pay dividends to continue to do so. That's a differentiating component of a company. On the other hand, companies are withdrawing buybacks for many reasons. Part of it is remaining and retaining that flexibility and that liquidity. That's why the record amount of corporate bond issuance, companies are trying to shore up their liquidity. So the idea of what do investors want companies to do? They want them to remain in business. Number one, first order business, and then where judiciously can they deploy capital? Probably you're likely to see, we're expecting a big drop in cash M&A, a drop in buybacks, a drop in dividends, and your CapEx will come down as well, particularly on some of the growth initiatives that can be deferred into the future.